For the longest time, investing in the hottest new startups was a game played exclusively by venture capitalists and the super rich. But now, those walls are finally coming down. You can get a piece of the action before a company even goes public. But as we're about to find out, that golden ticket, it might just have a very, very nasty bite.
So, let's get right to it. This is the big question, isn't it? You finally get access to that pre-IPO unicorn you've been watching. But what if I told you that company could get bought for hundreds of millions of dollars and your shares could still be worth absolutely zero? Zilch. It sounds crazy, I know, but it happens, and we're going to break down exactly how.
Okay, so first things first. Let's talk about the hype. Why is everybody so desperate to get into these companies before they hit the stock market? Well, it really all boils down to one simple, incredibly powerful idea: the IPO pop. Lately, you've probably heard this phrase, the democratization of finance, thrown around a lot. What it means is that platforms like Robinhood are now rolling out these features called IPO access. They basically get a big block of shares for their users, giving you a shot to buy in at the exact same price as the big Wall Street funds, right before it starts trading. And this number right here, this shows you exactly why that access is so valuable. Just take a look at Airbnb's IPO. If you were lucky enough to get in, you bought your shares at $68. The very first trade on the public market, $146. That's a 115% jump in a matter of hours. That kind of thing creates some serious FOMO. And this quote just nails the frustration on both sides of the coin. You've got regular investors who feel like they're locked out of easy money. And then you have the companies themselves who feel like they just left a giant pile of cash on the table. This shared frustration is what's pushing everyone to find ways for you to invest earlier. But this is where the real danger starts to creep in.
So, this is where we need to read the fine print. When you click buy on a share of a private company, what are you actually getting? Because it turns out not all stock is created equal. In fact, there's a world of difference between what you're buying and what the early VCs own. All right, pay close attention here, because this is probably the single most important concept in this whole explainer. You, as a retail investor, are almost always buying something called common stock. It gives you basic ownership, maybe some voting rights, but the key part is you are dead last in line if the company sells its assets. The VCs, they hold preferred stock. Think of it as a VIP ticket. It often comes with special perks, but most importantly, it gives them a priority claim. They get paid before you do, period.
And the legal mechanism for that priority claim has a name: liquidation preference. This is the VC's contractual superpower. It's a legally binding guarantee that if the company has a liquidation event, and that includes getting acquired, not just going bankrupt, the preferred stockholders get all of their money back first before a single penny can go to any of the common stockholders. So this brings us to the core analogy here, the liquidation waterfall. I want you to picture one of those champagne towers at a wedding. You pour the champagne in at the very top, and it has to fill up each level of glasses completely before it can spill down to the next. The money from a company sale works the exact same way. And the pecking order is crystal clear. The first glasses at the top belong to the debt holders, the banks. They always get paid first. Once they're full, the money overflows to the next level down, the preferred stockholders. This is where the VCs are sitting with their glasses out. And only if their glasses are filled to the brim does any money trickle down to that final level at the bottom. And guess who's holding those glasses? That's you.
And this quote from our source material really doesn't pull any punches, does it? The hard truth is that in a lot of sales, the ones that aren't spectacular home runs, that last set of glasses for common stockholders, it often ends up completely empty.
Now you might be thinking, all right, I get it. I just need to invest in a company that has a massive blockbuster exit. But it's not always that simple. The story can get way more complicated, especially when a startup that was flying high suddenly hits some turbulence.
So let's walk through a pretty typical scenario. A company raises its Series A at a nice $100 million valuation. Everything's great. Then they raise a Series B, and the valuation explodes to $500 million. This is when you get excited and decide to invest. But then the market cools off. The company needs more cash to survive, but now the best valuation they can get is only $250 million. This is what's known as a down round.
So what's the big deal about a down round? Well, to convince new investors to put money in at that lower valuation, the company has to issue a ton of new shares. This is called share dilution. Think of the company as a pizza. To get more money, they had to add a whole bunch of new slices. The pizza might be bigger, but your original slice now represents a much, much smaller piece of the whole pie.
All right, so our company has gone through a tough down round. Your shares have been diluted, but they made it. They survived, and they eventually get acquired. This is the moment of truth. Let's see how that liquidation waterfall plays out in this exact scenario. Okay, let's do the math. Our company, Unicorn AI, gets acquired for $300 million. That sounds like a win, right? Well, let's follow the money. First, the Series C VCs who invested in that down round get their $50 million back. Check. Then, the Series B VCs get their $150 million back. Check. After them, the early Series A investors get their $50 million back. That's $250 million off the top, all going to preferred stockholders. There's $50 million left over, which maybe the founders get. And you, the common stockholder who invested $50,000, look at that bottom line. There's nothing left. Your glass is empty.
Let's just say that one more time so it really sinks in. The company was sold for $300 million, and you got nothing. Not a dime. The VC's liquidation preferences completely wiped out your investment. They were made whole, you were not. And all of this leads to a very important, maybe even uncomfortable question. If the risk for common stockholders is this high, why are early investors and insiders suddenly so eager to sell their shares to people like you?
Now look, to be fair, insiders sell for all sorts of legitimate reasons. Maybe they want to buy a house or diversify their portfolio, but we absolutely cannot ignore the giant information gap. They live and breathe this company every single day. They know what's really going on under the hood in a way that you, as an outsider, just can't.
And they have a specific tool that allows them to sell their shares. It's called a 10b5-1 plan. Think of it as a legal framework that lets an insider set up a prearranged schedule to sell off shares over time. It's basically putting your stock sales on autopilot to protect yourself from being accused of trading on secret, inside information.
And when you dig into the data on these plans, it's pretty eye-opening. Research has found a really clear pattern. When insiders set up a plan and start selling very quickly, within 30 days, their companies tend to underperform their peers by about 2.5% over the next 6 months. If they wait a bit longer, the effect gets smaller. And if they wait more than 60 days, the advantage pretty much vanishes.
So, what's the takeaway here? Well, the data strongly suggests that insiders are pretty good at timing their sales. A fast sale right after setting up a plan can be a major red flag. It often means they're getting out before some bad news becomes public knowledge.
So, the next time you get that email or that notification, the one offering you an exclusive chance to buy into a hot pre-IPO company, I want you to remember that waterfall. And before you do anything, you have to ask yourself one critical question. In this transaction, am I the smart money finding a golden opportunity, or am I just the exit liquidity they've been waiting for?